What's up, y'all? It's Dr. David Roney. Just parked. This is day 16 of 31. So like at the hump, over the hump of my personal challenge to create more content, talk about finance a little bit more, and just like openly discuss how I think about things. So yesterday, I've been enamored. I think everybody is, right? Like, you see all these shows and you like all this stuff. You hear about these crazy returns in the private market. Private markets, think about like real estate, private equity, venture capital, all these things, like, because private markets work different than public markets. Public markets, again, are like the stock market, right? Think about the stock market, the bond market, things that are publicly traded. There's low barrier to entry. Like, you don't need a salary requirement. You don't have to meet network or worth requirements, right? In the private markets, it's a little bit different, right? Like, there's a hurdle to entry because there's more risk there, right? There's less transparency, there's more risk. And so typically there's like the quote unquote accredited investor definition that you need to meet. Typically that means that you have a certain net worth. Usually it's like greater than $1 million, or you pass the financial test, which that's a newer requirement, like the Series 65, Series 7, or you've made, I think it's 200,000 as an individual and 300,000 as a joint married couple for at least 2 years, and you have that expectation of at least that income moving forward, right? That's how you meet the definition. But anyway, I've always liked startups. I always thought about like how to invest in startups. Like, it seems kind of cool. Like, one of my favorite shows was Silicon Valley, which is hilarious. If you haven't seen it, go watch it. But Angel List is something that I always keep an eye on. So I like officially signed up, right? Like, hey, let me submit my application. I went through and I wanted to see what my options are. There's syndicates, there's rolling funds, and a syndicate is basically like per deal basis, where they, like, someone has a fund, they roll up a certain, they get a call and figure out who they're going to include, and there's a certain amount of money you put in, right? Like, there's minimums, yada yada. A roll up or a rolling fund is basically like ongoing, like perpetual. Hey, you're putting in a certain amount of capital per quarter. Like, there's some that are as low as like $2,500. I think I saw one that was like $125,000 per quarter. First off, whoever's doing that, you balling. Shout out to you. Cool. But like, one of the things I looked at was like, man, there's a cornucopia, is what I use on Twitter, of like options, right? Like, how do you know like what's a good fund to put in? And really, I've always talked about venture and private equity being like a spray and pray, right? Because you expect majority of the startups really to go to zero, and you're looking for this sort of quote unquote power law effect, where if you put in a number of bets, because they are bets, eventually if you can put in enough of it and play the game long enough, you're going to have a 1 to 2 or 3 that are going to have such outsized returns. It's going to both return your capital, and you'll have a high return on investment, right? Because you're super far along the risk curve. You're taking a lot of risk to get a lot of reward. And there's some things that I've read previously, because I read Venture Deals by Brad Feld, which is a really good book. I've read Angel by Jason Calacanis, which is a really good book. Not an endorsement of him, but a good book. And I've just sort of paid attention, and I've absorbed the ecosystem. I've read everything I could. So I've learned a little bit. I was surprised how much I've learned of listening through and really taking the time to learn and stuff. But like, one of the stats they have on Angel List is the percentage of follow-on investments, which I think is actually something I got to pay attention to, right? If I'm going to put money in a syndicate and back whoever, and I just need to spread my bets along and be diversified across all these funds, then my goal should be to put them in funds that have gone on to see like startups that have funded startups before that have gone on to follow-on investments. And I think that's an important stat, because follow-on investments right off the bat like are indicative of that, hey, that startup is surviving to go on and try and raise additional capital. So that's usually a good marker, right? If they can survive long enough to go on and raise additional capital, one, it doesn't necessarily mean that they're a good business, right? They could just be burning capital. Or it could be like, hey, they're actually moving along and investors do see progress. Maybe they got product market fit, things of that sort, to actually go on and deserve that capital. Private markets in general, there's a lot of stuff that I pay attention to. One is Farmland, right? And one of my favorite things to look at is Acre Trader, right? Because for some reason, I grew up in the cities, but I have like this huge fascination with farms. I love them. I don't know if it's necessarily I want to personally live on one, but I do like farms. I like the thought of contributing like clean energy and like getting money back from contributing into that stuff. So I pay attention to Acre Trader or Farm Together. I look at those things, again, private market stuff, right? And look at the returns you can invest in, like apple orchards and things of that sort. I'm not 100% there with the real estate type syndication investments. I don't know if I can wrap my head around it. A lot of this stuff is hard to wrap your head around, right? The venture capital stuff, the angel investment, and all that stuff. Like when you invest in that type of stuff, there's usually a management fee of like 2%. They call it like the 2 and 20, right? Like the old hedge fund model, but 2 and 20. But like 20% is like 20% of your returns are going back to the person who is managing it. And so they're managing other people's money. That's typically how people get rich in finance, is the fund managers tend to get rich off of other people's money from managing it. And you have confidence in them. That's like their incentive. If they can do well, they can get 20%. And then they sort of just roll that money into another fund, and then it just slowly like compounds over time. But like for me, like growing up in poverty, it's hard to give up the control of your money, right? But like if I talk to people who are way, way wealthier than me, they have no problem. Like, look, man, I'm willing to pay for that peace of mind. I'm willing to give them that little carrot in order to get outsized returns, because I can't get the deal flow that they're currently getting. The biggest thing in private markets is getting deal flow, and having deal flow means you're tied into the networks that potentially will get those outside returns. The reality is it's the Sequoias of the world, the A16Zs of the world, the benchmarks, all these like famous venture capital funds. Like somebody like me isn't getting access to it, right? Like I'm the wrong demographic. I'm from the wrong side of the block. And that's like, I'm like majority of everybody else. Like regular people aren't getting access to that. That's just not how that's working. So you got to be in a spray and pray mode. Like, man, if I put enough bets and I keep my overall exposure of my portfolio low, right? So like this isn't something that you just go all in with. You don't go put a 50% of that. That's a good way for it to go to zero, right? But like 5, 10%, you got to figure out what works for you. 1, 2% of your net worth. That's important. And so I think having exposure to private markets is important. And there's a lot of different ways to do it. Like I said, I do have a fascination with it. I think it's cool because really what you're doing is you're investing in people, and I like investing in people. I'm not 100% sure I am okay with the management fee stuff. Not necessarily management fee, the carry fee. I do think that's a hard like pill to swallow, partially because Vanguard kind of ruined the world on this. And like your expectation of fees is to be low because Vanguard's low, right? Like you're like, damn, I can be paying like 0.03% or aka 3 basis points. Again, a basis point is 1/100th of a percent of 1%, right? So a basis point equals 1/100th of a percent. So 3 basis points, that's fairly low, man. And so you're talking 20%. I was like, oh man, it's a lot. But I think I'm going to get there. I just have to wrap my head around a different mentality and get out of the poverty mentality and go ahead and start to like move forward and really understand that I have to think how I want my future self to think, which is my future self will be in a position where I can have generational wealth. And by generational wealth, I mean generational wealth for people who look like me, right? I want to change the narrative as I talked about before. But anyway, I hope everybody's doing well. It's day 16, man. I'm almost there. 15 more days to go. I've already done 16 in a row. It was tough so far. It's all down here from here, man. I hope everybody's doing well. Please hit that like and subscribe button. Follow me on Twitter at FiSurgy. And I'm happy that I really, really am happy that everyone sort of has been supporting me along this journey. I really appreciate it. I hope everybody's doing well. Talk to you later. Peace.